Good morning. Welcome to Stock Market Today. It's Friday, August 23rd, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider in your inbox every trading day before the market open. So U.S. equities were mostly lower in Thursday's trading. Treasuries were weaker across the curve with a focus on intraday inversions of the 210 spread once again. Dollar was weaker versus the yen and little changed on the euro cross. Gold finished down 50 basis points and WTI crude settled off 60 basis points. So the S&P 500 continues to trade in this range. We'll look at that in a little while. And as we get to the desk this morning, futures point to higher open today by about 40 basis points. Markets on pace to break a 3-week losing streak. Asian markets were higher overnight. European markets are bid as well. Treasuries are weaker across the curve as yields have trended higher for most of the week. The dollar is stronger on the major crosses. Gold is down 10 bips and WTI crude is off by 20 basis points here today. And let's dive right into the S&P 500 chart. Really, you can see this churning in the 2850 to 2950 range. And yesterday was kind of a volatile day. If we looked at an intraday chart, you can see gap open, quickly reverse course down on the day to then close flat. So a volatile range in front of Powell's speech today. Remember, Chairman Powell is set to speak at Jackson Hole. Support remains in that 2800 to 2850 zone. 200-day moving average is now in the support zone, 2801.98 for the 200-day moving average. Resistance is in this area between 2900 and 2950. We're there. Matter of fact, we're going to start calling it 2930 to 2950. I mean, I like to give myself a little bit of room there, but that does seem to be the case for now. We'll see how the day plays out with Fed Chair Powell, but the RSI remains below 50. So momentum not getting there on the upside moves. We've been talking about it for quite some time. Chaikin money flow is bullish, but heading lower. We're highlighting the series of lower highs as the market trades to successive highs, right? New all-time high, S&P 500, lower high, Chaikin money flow. New all-time high, S&P 500, lower high, Chaikin money flow. Bigger picture trend, but something to be aware of. In the near term, we have the chop going on, and that remains in place. Perhaps Powell breaks us out today to the upside. We don't know. Expectations are for him to lean dovish, but there always tends to be a little bit of volatility around Chairman Powell's speeches. So our market in a minute. What are we talking about in our note today to Chaikin Analytics clients? Stocks open higher, sell off, then close nearly flat. Powell to speak at Jackson Hole today. Everyone will be watching that. Key themes rebound on the week, especially the ones associated with risk. Semis continue to trade well on a relative basis, and futures do point to a higher open here today, as we said. Getting into the power bars now. Not a lot changed yesterday. Dow still 3-1 bears to bulls. 9 bearish or very bearish stocks, 3 bullish or very bullish stocks. S&P 500 still skewed in favor of the bears, 98 bears to 82 bulls. NASDAQ was the underperformer yesterday. And remember yesterday, that was 21 to 21 or 22 to 22. It was even. We've kind of shifted slightly back to the bearish side of the coin. 23 bearish or very bearish stocks, only 21 bullish or very bullish stocks there. Small caps remain skewed in favor of the bulls, but it also remains the underperforming group of the major market indices. 398 bulls, 363 bears, down 22 bips yesterday, underperformed the S&P 500 once again. Bonds down ticked, as we said, and they have seen a bout of profit taking this week. According to the Chaikin Power Bar, small cap stocks remain somewhat more bullish than large cap stocks. Major markets are mixed. Let's hit our stock of the day now. Renaissance Re, RNR is the ticker symbol there. Closed at 188.23, down 6 basis points yesterday. Renaissance Re has a very bullish Chaikin Power Gauge rating due to very positive expert activity, attractive financial metrics, and strong price volume activity. So we take the 20 factors, 5 of them in each of these 4 categories, and we come out with our very bullish rating. We have a very bullish stock, strong trend, strong industry group. Market and model are in agreement, and they have been for some time, right? We've been bullish on insurance for a while. It's been a leading industry group, and we've highlighted a lot of names within that group. Renaissance Re has been outperforming since last November. What I don't like here in the near term are a couple of things. Number one, bearish money flow near the highs. That's a red flag for me, a caution sign, if you will. I don't like to see stocks making new highs with bearish money flow. That could be an indication that people are using strength to get out of their positions. On top of that, the stock is overbought. Right, it is above a rising long-term trend line, solidly outperforming the market. So market and model are in agreement. If we drop down this checklist, you'd see a mixed bag due to overbought, due to money flow. But I think this is a name to keep an eye on. I think if we can round out of this overbought condition and see an improvement in money flow, you pull back to the 180 level, R&R starts to look pretty interesting to me. So nothing to do here today other than add it to a watch list. And when markets are choppy the way they are right now, this is a great time to be building your watch lists, your bullish watch list. The names that are in leading industry groups that are outperforming, that are holding up the best as the market is choppy, those have the potential to be real leaders when and if the market does break out. Build your watch lists. Sometimes that could be the only activity you take on the day. You don't always have to be trading. You don't always have to be putting a position on. Maybe you're just building a watch list and then getting on with your day. Perhaps that's what you're doing today with Renaissance Re. Our sector tracker now, looking at the movement of the major sectors over the last 5 days. Discretionary, tech, industrials, and energy are the top 4. All sectors are higher. Fins, comms, staples, REITs, middle of the road, Utes, healthcare, materials, bottom of the list. So, as we said, market on pace to snap a 3-week losing streak. Good to see discretionary and tech towards the top of the list. A little bit of a counter trend move in energy. I'm still not convinced on energy, and that's fine. Listen, I'm not going to be convinced on energy until energy starts to move higher. I'm not going to try to cherry pick the bottom there. Just not my style, not my MO. Financials seeing a little bit of a rebound of as rates have backed up a bit, and the defensive areas have kind of backed off a little bit as the market has trended higher this week. Staples, REITs, and utilities and healthcare. Materials group that we've been warming to, largely due to its precious metals exposure, seeing some profit taking there as well. Your industry in focus today, bank services. This is just a solid conundrum for us because within our model, the bank services groups look good from a fundamental basis, right? 19 bullish or very bullish stocks, 7 bearish or very bearish stocks. But it's been a massive underperformer over the past 6 months, down nearly 14.5% on a relative basis. Why is that? Rates. Rate-sensitive names, right? This is why relative strength and relative performance and skewing to the strongest areas is so important. Because if you're sitting there looking at the bullish fundamentals in banks and wondering why you're not making any money trading bank stocks, it's because the market's not ready to recognize it yet. There are bigger factors at play here. Now, power bar ratio is strong. It's ranked number 6 of 21 subsectors. Right? There's some interesting looking names in there. First Horizon, Western Alliance, Simmons First, right? FHN, WAL, and SFNC, respectively, all with bullish cheek and power gauge ratings. But you just got to be mindful of what the drivers of your stocks are. You don't want to own bank stocks in an environment where global rates are cratering, where U.S. rates have scope to go lower. It's a tough environment to own banks, even the fundamentally solid ones. That is why we look at the relative strength. Here's KBE. You can see that, right? Here's the power bar, 19.7, but it has a neutral rating. Below a declining long-term trend line. Massively underperforming the market for most of the year, really. And the intensity of that underperformance picking up of late as rates have fallen off a cliff. No real tell from money flow, right? But you can see the trend. The weight of the evidence supports not being long bank stocks. Right? Even the bullish ones. Be aware of the dynamics that are at play. Banks are a mess right now, at least because of rates. Taking a look at what's trending now. Yesterday's S&P 500 gainers and losers. JW Nordstrom Less bad is good for the stock here. 15.86% to the upside. Keys earnings takes that stock higher by 12.5%. Alexion, some positive comments out of the sell side yesterday, sent the stock higher by 7.5%. Foot Locker up 5.5% yesterday, but look out below this morning, trading down about 11% as they came in weaker than expected. And Synopsys has been a bellwether name for us here at Chaikin Analytics. We've been all over it on the long side. Their report, stock goes up by 5.5%. Loser side of the board, Mattel. No real news there, 4.5% to the bad. Albemarle, didn't see any news to take that stock lower by 4%. Cigna and Humana under pressure due to some private company competition within their space, and L Brands reported earnings. That stock lower by 3.5% today, or yesterday rather. Let's dive into the charts now. Semis continue to trade well on a relative basis. Here's SMH, the actual fund, in a consolidation, holding above support, above a rising long-term trend line. Notice that on this pullback to support, RSI did not become oversold. And now notice the difference here. Notice the difference here between this and the S&P 500. Notice the S&P 500 became oversold and now can't get back above 50. SMH did not become oversold. RSI back above 50. Are we screaming above 50? No, but it's a nuance. It's a dynamic that you need to pay attention to if you're going to use these indicators. Because we care about semis and we care about their relative performance. And as semis continue to do well, that increases the odds that the market will move up and out of this consolidation. As we look at the SMH relative to SPY, we can see a nice uptrend, consolidation within that uptrend, but holding above support and continuing to move higher. To the extent that semiconductors are outperforming the S&P 500, that is bullish potential for the market itself. We watch this every day. I report on it every week, sometimes more than every week, more than once a week. This should be a mainstay chart in your analysis. High yield rebounds versus treasuries. Now remember, treasuries were massive outperformers last week. The curve inverted last week, right? But a lot of that outperformance was purely a function of treasury strength, right? This ratio cratered as a function of treasury strength, not so much high yield weakness, which is kind of interesting, right? High yield is a sign of risk taking. Treasury is a sign of protection, right? Risk aversion. So treasuries have been outperforming for some time, right? That's what this ratio tells us, below a declining trend line, right? High yield is underperforming when this line's heading lower. We care because it's highly correlated. This ratio is generally positively correlated to the S&P 500 on a rolling 3-month basis. That's what we're looking at here, rolling 63-day correlations. And you can see that for the most part, pretty much except for late 2017, the ratio is positively correlated to the S&P 500. So if high yield can start to outperform treasuries, that's bullish for the market. Treasuries continue to outperform high yield, market likely remains choppy. Right? What I think is happening is people are getting pushed out on the risk spectrum a little bit because high yield is not breaking down the way the strength in treasuries would imply it should be, which tells me that people are stretching for yield and they're looking at high yield. I don't know how that's going to play out, but just something to keep in mind. One of the dynamics at play in the marketplace right now. But it did rebound nonetheless as the market has moved higher. Telecom, however, is a weak industry group in a choppy market. Here's XTL, SPDR S&P Telecom ETF. We can see here that after making a high, it's gone into this choppy consolidation and looks to be rolling over. Below the 200-day moving average, series of lower highs for the RSI. Now, I mean, some will say that we haven't become oversold, but okay. We also haven't become overbought. So choppy at best, right? Choppy at best. If we look within Chaikin Analytics, we can see 11 bearish or very bearish stocks, 5 bullish or very bullish stocks for XTL, and a steadily declining line relative to the S&P 500. So a clear underperformer for the telecom space, and one of the weak stocks within the telecom space, Cisco. I'm highlighting it in my note today to Chaikin Analytics clients. Bearish rating, weak trend, weak industry group triggered a sell signal today. Stock is underperforming the market with bearish money flow and on its way to an overbought condition. If you're looking to trade both sides of the market here in a choppy market environment. If you're looking for both long ideas and bearish ideas, I think you want to take a look at Cisco on the bearish side of the coin. A little bit of a rally here back into the bands gives you that opportunity. Have a great weekend, everyone. I will see you tomorrow, Monday.